Let's talk more about the big week ahead, including the Fed chair's testimony. Our next guest says it is time for the Fed to cut. Joining us this morning is Moody's chief economist, Mark Zandi. Mark, it's great to see you. You've been pretty consistent in your arguments of late. I wonder if you think Simtra and this week on the Hill, if you feel at least the narrative around the Fed coming around to your point of view.
I do. I think they're moving in the right direction. I think the Chair Powell has a script. He's going to continue to say that he needs to see a few more good inflation statistics numbers in the months ahead. I think he'll get them. I think inflation is, all the trend lines look good, moving back to target, and I think he'll get the numbers he needs. And I would expect them to start cutting rates in September. Now, if I were on the Fed, I'd have been arguing for rate cuts at the end of last year. I think they're taking an increasing risk of putting too much pressure on the economy and financial system and ultimately potentially breaking something. And I don't think that's necessary because the economy is at full employment and, again, inflation's headed back to target. But, I'm not on the Fed, and that they have a different judgment. But I think they'll have the evidence they need to start cutting rates in September.
So you feel like July sets the T for September then?
Yeah, I do. I think look at one, you were talking about the CPI number that we're going to get that on Thursday. That'll be a good number. I think the headline will be flat, 0, no increase. The core, excluding food and energy, will be up 0.2%. That's kind of right exactly where they would want to see it. So with that, I think they'll have enough to kind of lay the groundwork at the July meeting for a September rate cut.
What about we were talking about the other side of the mandate, which we're increasingly talking about, Mark, the jobs picture and how it's kind of moderating, cooling might be strong, weakening might be strong. Where do you think that ends up? Because sometimes when you do see unemployment rate climb, what are we, 0.7% off the lows, you can really see that start to pick up if the Fed doesn't do anything about it.
Yeah, that's what I worry about. I mean, the economy is slowing. You can see it everywhere. You can see it retail sales, vehicle sales. You can see it in the GDP number. GDP growth in the first quarter was 1.4%. The second quarter, based on all the data we're getting, it's tracking about the same, 1.4. That's below the economy's potential. That's why unemployment is moving higher. We're up 0.5 point, over the past year. Clearly labor supply is playing a role, but nonetheless, it's starting to move higher. Initial claims are moving higher. I mean, hours worked are down, temp jobs are down. The revisions we're getting to the data, that we got last week would be consistent with an economy that's downshifting. All that is okay, but, I get increasingly nervous about it. Again, in the context of, they've done what they need to do. We're at full employment and inflation is within spitting distance of target and clearly headed in that direction. So you're taking a risk here. Something.
So is September too late? You think they're gonna wreck the recovery? I mean,
no. I mean,
the soft landing.
I think September's okay. It's fine, but the odds of them making a mistake are higher. The risks are mounting. So I think odds are that we'll be just fine, and September is soon enough. But why take that chance? Why take that risk? And it's not only about the real economy. The financial system is also under tremendous pressure. I mean, the yield curve is still inverted. Short rates are higher than long rates, and that's not consistent with a well-functioning economy or financial system. And banks and other financial institutions and markets are under a lot of pressure. And again, I don't. The odds are that it won't break before September, but why take that risk?